Good evening, or afternoon, or morning, wherever you are in the world. Welcome to the third Pacesetter Capital webinar. I'm very happy to be speaking to you today. I need to warn you that the slides today are going to be below quality of compared to previous webinars. Our usual designated Canva expert is currently working in America, so you have to make do with my back to the 90s or early 2000s Microsoft PowerPoint slides. But obviously the main thing is hopefully the information that I'm going to be giving to you today. So the topic of today is maximizing cash flow and managing properties. This is something that I've been doing for quite a while now, trying to get the most out of our assets here at Pacesetter, and managing my own personal property as well. I'll give you a quick, very brief introduction to what Pacesetter is. So we're a fairly new company. We've only really just got started in the last year, and we've finished our first fundraising round towards the end of 2024, beginning of 2025. We had a great fundraising round. We had a lot of demand from new investors all around Europe. As you can see, there's many countries listed here: Estonia, Italy, Poland, Czech Republic, Slovakia, Romania, and of course the UK as well. Our unique selling point, I guess, is just being able to access the UK market, but that's not what we're going to be talking to you about today in terms of the company, but it's all going to be about value in terms of how things work in the UK related to managing properties and cash flow. So let's start off with a really basic, simple concept. What do we mean by cash flow? Essentially, it's the amount of money that's left over every month once you've taken away your expenses. Now, we're going to go into a little bit about what these expenses are, but obviously the main income, if you're talking in terms of real estate, is rent, collecting rent. And in terms of expenses, you obviously have things like mortgages, Wi-Fi that you might provide within the property. You've got to pay for insurance. If you have an apartment, there'll usually be building fees related to the apartment to maintain it and to keep it well lit and secure, etc. And so whatever you have left over after that is your cash flow. So why is positive cash flow important? Well, obviously, if you have negative cash flow, then like in any business, you're not going to be able to pay your bills. Now, this is particularly important related to real estate and property, because obviously if you don't pay your bills in real estate, the main bill that you will have is your financing costs, so your mortgages. And if you don't pay that, and you don't pay that for a number of months, then the bank might decide that you're now a delinquent borrower, and they might come and take that property back off you, which obviously is not good because that can have a domino effect. If you have multiple properties, it can affect your ability to get loans in the future. So yeah, it's very important that we pay our bills when we're investing in property, when we're investing in real estate. And so that's why positive cash flow is super important. So we mentioned a little bit of our key cash flow drivers, and I've kind of put green in terms of our rental income. As I mentioned, this is our main income when we're investing in real estate. And then we've got two costs or expenses that I've highlighted in yellow. I've highlighted these in yellow because they are somewhat known, so they're somewhat controllable. And then I've got vacancies and maintenance, which is somewhat controllable, but it's less fixed in essence. So operational expenses. So let's start off with financing costs, actually, because this is our main cost when we're investing in real estate. So generally, unless you're very lucky or you have a very big cash pile to start with, you're probably going to need to borrow when you're buying your first property, or you might be buying a property that's very cheap that you could pay for in cash. There's lots of arguments why it's good to get financing on properties. Obviously, you can get more properties for the same amount of cash if you're utilizing financing. But this is the main cost, and this is probably your biggest cost related to buying property. And I've got a case study later on, which I'll show you an example of one of our properties that's going through, and to kind of illustrate what we mean as well by financing costs and how that affects the returns. Then we got operational expenses. So this is the kind of things that that are going to come out, and the price that they're going to come out. So one might be insurance. Now, in real estate property, it's generally common to buy a full year of insurance up front. but you can spread that cost into 12 monthly payments. Building fees, they could be monthly, they could be quarterly. Most of the properties that I manage are quarterly, so there's a charge quarterly. But when I'm budgeting, I'll kind of divide that into monthly chunks, just for ease, essentially. Also Wi-Fi. So in Pacesetter, we operate in the shared accommodation space, where there's usually more than one tenant operating a property. And so we will generally pay for the Wi-Fi, the internet, because that's sort of what's expected in the UK in shared accommodation. You might have some countries, some places that don't charge for that, but that's generally what we tend to do at Pacesetter. The reason for that is, since this is a kind of UK property expo, and I know some of you will be abroad, in the UK, when you get a Wi-Fi contract, it's for 18 months and it's attached to the person or the individual that's taking out the contract. So in our tenant mix, we have students, and if they're only going to be there for 12 months, but they have an 18-month contract, they might not be willing to do that. But I do know of landlords that operate in the UK that do put that onus on the student. We're just using it as kind of a unique selling point why we wouldn't do that. So that's just something for you guys to think about. Then we move to vacancies and maintenance. Now, generally, you can avoid vacancies. Tenants need in Scotland, at least, or in the UK, need to give you at least 28 days notice to vacate. So you do have some time in order to find new tenants. So if you're very hot with finding the replacements, you can avoid vacancies, but sometimes it might not be avoidable. For example, in the UK in the summer, students are moving out. There's not so much demand in certain areas, in the student areas, the university areas. You might get some summer students, but that's when you might have some vacancies in the UK student market. And then maintenance. You never know what might come up. For example, 2 months ago, I had to replace a shower unit. In another property, we've had to have the boiler fixed once or twice since September. So these are just things that pop up that you'll need to fix. So with vacancies and maintenance, it's important that you have a kind of backup, a kind of budget in place for when that, just in case those things do happen. So that's why they're in red, just because they're a little bit of a sort of guesswork. You never know what vacancies or maintenance problems you might have during the life of the financial year. Okay, so let's quickly go over some options. We've covered this in previous webinars, but these are the kind of main 4 options when you have properties in the UK. We have single let, so this is generally to families, to a working professional, a couple, and they basically take over the whole property instead of renting out by the room. The opposite of that is HMOs, where you have more than one tenant within a accommodation. So you might have 2 students that are sharing, for example, and so they're renting out parts of the flat as opposed to the whole flat. And then you have serviced accommodation, also known as Airbnb is the most common, but of course you have booking.com, things like that. This is good for certain locations, particularly city centres, if you have tourists or people that are coming to visit on business. So you can also do that as well. And that is kind of a short-term rental. And depending on the area, depending on the location, that can be more profitable than the others, especially in places like London, places like Birmingham, Manchester, where there might be a lot of tourist appetite. Edinburgh is very big in Scotland. So this is good for certain areas where there's a big tourist appetite. Okay, so let's talk about tax efficiency in the UK. And so this is important when we're maximizing our cash flow, how we set up the ownership to maximize or minimize the amount of tax that we want to pay. So in the UK, you can own property 2 ways, technically 3 ways, but we'll just stick to the main 2, which is limited company. So this is when you set up a company and you buy property through that. Second way is in your own personal name. So for myself, Ashley Carr, I cannot own a property and the owner can be Ashley Carr, or the owner can be Pacesetter, which is our limited company. Now, up until about 5 years ago, it was more advantageous to hold that property within your own name, but then they changed the rules so that you couldn't write off the mortgage interest every year anymore. So obviously, if you own a property through a company, the interest that you pay on the mortgage, so the financing, is a tax deductible expense. Just like if you owned a corner shop, when you're buying certain things, or when you're paying for your electric bill. These are all kind of business expenses. So it's now more advantageous generally to have a property within a company, and this graph kind of illustrates that. So in the UK, most people are going to be basic rate taxpayers, in which case it might be advantageous to have it in your own name because you can deduct that mortgage interest. Whereas in a company, your tax rate is 19%. And so you'd need to deduct the tax at a different stage. And so you can see from the net profit, it's a bit more advantageous if you're a basic rate taxpayer to own the property. But most people that are investing in property are probably going to be a higher rate taxpayer, in which case it's because their income is going to be above a certain level. And so in that case, it's more advantageous for a limited company. Obviously, with Pacesetter, we are, we have multiple shareholders. So for us, it's only really possible, obviously, to buy property through a company. Okay, so another good way to obviously maximize your cash flow is to increase your rental income. Now, a way we do this at Pacesetter is because we're dealing generally with students that will be staying for months rather than years, maybe 1 year maximum generally. We will look at between tenancies whether we can review that income. So we might have someone that's paying £600 a month from September 25 to September 26. And then in September 26, we'll reassess that. We'll look at what other stuff is on the market, or more like August, obviously, when we're looking for the new tenant. What else is on the market? What's in the area? What's the going rates? And then we might need to adjust accordingly. There's cases where you might need to adjust downwards to keep a good demand. But very often, especially if there's a lack of housing supply like there is in the UK, and particularly in the areas we operate, there's a chance that you might be able to increase that to a new level. Another way is upgrading. So you could, get a new kitchen in, you could upgrade a boiler, that kind of thing. And so because the property might be more efficient, the bills might be lower, then in that case, you can go ahead and increase some rent. Another way is to kind of package the rent with other things. So for example, this isn't generally done, but in some cases, especially single lets, if the landlord provides the furniture, then they could charge a higher rent for that. Whereas if the tenant would have to provide the furniture, the things like the beds, things like tables, that kind of thing. In our realm, we're generally, letting to students. So, they're not going to bring their bed from home, especially if they're from a foreign country. We provide the furnishing. And so that's kind of inbuilt within our rent. What we don't do, though, is we generally don't provide bills. So in terms of the heating and the gas and the electric, generally that's up to the tenants to pay. If we did include bills, then we could look at increasing the rent. However, we feel that just for the sake of hassle, it's better to kind of let the tenants deal with all of that stuff, because you might include bills and then the tenants are like, oh, we get free electric, let's leave all the lights on. We get free heating, let's leave the heating on all the time. So it just allows them to be a bit more cautious with their usage as well. So reducing vacancies, we mentioned how that can definitely impact cash flow. So there's a few strategies we can do to mitigate that. Number one is obviously effective marketing. So making sure that we're advertising as much as possible. And what I'd like to do is I don't just advertise what's available. I will also seek out tenants as well. So there's certain portals where tenants can advertise themselves, and then you can actually go out and message them and say, hey, I can see, you're looking for properties in this area. I can see your budget's this. My advert matches that. Check it out. Let me know if you've got any questions. So it's really, really being active with your tenant finding as well, and your marketing. Management's really, really important. So, trying to get as much warning as possible for when someone wants to leave. So if someone wants to leave in August, ideally you should be finding that out in June, preferably early June, so that you've got a good, clear amount of time that, okay, right, I need to get that advert up. I need to be really active and looking for a new person. And then retention. So you might offer reduced rent during the summer when it's generally a bit trickier to find people. You might, reduce by £100, £200 just to keep that tenancy going. especially if someone's going to come back in September. You, instead of finding a new person for September, you might say, look, if you stay, I'll reduce the rent by £200 a month for throughout the summer, and then we can pick back up again in September. So if you can keep that tenancy going, then that's a really good strategy for reducing vacancies. Okay, expense management. So another way is kind of maintenance in a way. So, for example, instead of paying each time for someone to fix your boiler, which, if you're not familiar with the term, if you're from abroad, that's like the big water heating system that will heat all the radiators around the property and make sure the water for showers, etc., is hot. So instead of paying each time, you might just get a service contract. So you might pay, let's say, £30 a month for 12 months. And let's say your call out charge is like £170. If you have that, and you've already saved money by 2 call outs. So that's another good way to do that. Preventative maintenance. So, for example, if you get a property with a very old boiler, sticking on the boiler theme, and the boiler's 30 years old, it does work, but you feel like you might have some maintenance issues, then it might be better just to cough up and get a new boiler in, so that you're not going to have constant outgoings of fixing and maintenance. So that's what we mean kind of by preventative maintenance. And then insurance savings as well. You can look at, if you have multiple apartments, you can maybe do a deal with the insurance company and say, hey, I've got 3 apartments. Can you give me a better deal than if I'm just going to do one at a time? Let's work out a discount here. So that's another thing you can do to bring your monthly costs down. Another thing is mortgage optimization. Now it's up to you how you kind of go about this. You can remortgage you can remortgage at a higher rate, so you can put down more money so that your monthly costs will be lower. That's kind of how we can maximize our cash flow. Most landlords, though, will actually choose to remortgage at higher rates, so they'll get more of a loan. Even though they'll be paying more per month, they might be able to release some capital that they can use for something else. So it's all about thinking, right, do I want to take on more debt and maybe use some capital elsewhere? Or do I want to reduce debt and get a lower monthly payment, but I'll obviously be tying up more capital? Depends on your risk appetite at the time. You can also look at fixed versus variable rates. So a fixed rate is when the interest rate stays fixed for a set number of years, usually 2 or 5. So you know exactly what you're going to be paying each month for 2 to 5 years. Or you can choose a variable rate where it will go up and down depending on a different interest rate, usually a Bank of England rate or a swap rate. Now, the good thing with the variable rate is you could obviously lower your payments if those interest rates goes down, but the flip side of that is that you could actually be ending up paying more if those rates go up. So we tend to fix because we would like that certainty of what we're going to be paying, but it's up to you if you want to kind of be a little bit more risky, or if you're fairly certain that interest rates are going to go down, you might want to take that risk and go on a variable rate, and that will reduce your monthly outgoings when that rate goes down. Then we have the difference between interest only and repayment. So interest only, this is a really useful graph, is when you're only paying the interest on the loan. So you can see that we've taken out a 200 grand loan, and that's staying fixed throughout the years, okay, because we're just paying off interest. The second is capital and repayment, which is the blue line. So you can see we're not just paying off the interest every month, we're also paying a little bit of the outstanding loan. So over time, that loan goes down and down and down. Now, obviously, the capital and interest, capital repayment is more expensive because you're paying off some of the loan as well. However, it's less risky because your borrowing is going down over time as well. A lot of investors, landlords, they choose the interest-only option because they like that additional cash flow. However, we at Pacesetter, we stick with capital and repayment, even though it's a little bit more cost. We like the fact that we're paying off the property each month. And in a way, we're owning a little bit more of the property each month, because we might borrow 75% of the purchase price at this level. But if we're paying it off each month, that means that 75% is going down and down and down till it gets to 60, 50, 40. And so we're, owning the property more and more in essence. So that's one couple of ways you can think about mortgages and financing. Diversification versus concentration. So this is kind of looking at risks. So, you can have a very concentrated portfolio where you basically put all your eggs in one basket. So if you know a city particularly well, you might decide to go all in on that. Or you could diversify where you have different cities, different regions. And so in the UK, this is more so to do with England. There's kind of a north-south divide where if you invest up north, prices are cheaper. And so you might get a bit more rental income for your purchase price. In the south, it's kind of the opposite. So, but in the north, sorry, your values might not go up so much. So the property price might not increase so much. In the south, it's kind of the opposite, where you're more likely to get that value of property going up, but the rental income compared to what you're buying won't be as high. So your yield, they call it, your percentage return is not going to be so high. You might look at different property types to diversify. So you could have some students, you could have some families, tenants, you can invest in some commercial, not even residential. You could buy some shops or some warehouses. You can look at that as well. And then demographics. So you might want to take on some students because maybe the returns might be higher. You might want some safer families, with big earnings. So it's up to you. At Pacesetter, we are in our kind of concentration phase. We know our particular city very well. We know the different areas. We know the prices. We know everything where we're going to be able to rent. So at the minute, we're kind of concentrating. We want to really kind of build up a presence in one particular city. But then over time, we'll need to go about diversifying. Okay, management best practices. Let's talk a little bit about those. So I always say, and this, if you're taking notes, this is really good. It's easier to prevent a bad tenant going in than to get a bad tenant out. Because once they're in, you have to go through courts, etc. So it's a real big hassle. So you really want to kind of be more of a preventer and someone that says no, and kind of really errs on the side of caution than just letting everybody in. So you want to do references, you want to do in-person meetings if that's not possible, virtual kind of video call meetings. You want to find out everything about them, social media, LinkedIn. You really want to find out a lot about someone. You want to make communication very clear. So you want to set out expectations from the start. It might be to do with, the rules of the house or cleanliness, etc. So you want to keep that really, really clear. If there are arrears, you want to manage them. You want to catch things early on. It might be a case that, they're really struggling right now. And so, you might come to a deal with them where you kind of forgive the arrears if it's only 1 or 2 months, if they move on essentially and maybe find somewhere cheaper or more affordable for them. Okay, so let's talk a little bit about compliance. So in the UK, every property needs to have an EPC called an Energy Performance Certificate, and that's what looks like this. This is from the days from when the UK was in the European Union. So for those of you that are in EU countries, you'll probably recognise that it's this or something similar. So it basically grades the property on how efficient it is in terms of lighting, heating, water. So the more efficient, for example, the best property is going to have solar panels. It's going to have a wind turbine in the back. Obviously, not many properties can have that, but the latest heating systems, the latest, most efficient boiler, energy efficient lights in all places, and then obviously the property that has the opposite of that is going to have the lower amounts. So this particular property is an E, so that's kind of low. You want to really kind of get that up. At Pacesetter, we kind of aim to have at least a D. I mean, ideally, you want to be aiming for C over time, but kind of as a starting point, a D is okay, especially if to get it to a C would only require some minor adjustments. You want to look at safety. Obviously, if every property needs a gas safety certificate if it has a gas boiler. Every property that has electrics, which is obviously essentially every property, needs what's called an EICR. Basically, just to confirm that the electric system's all fine, all the plug sockets are all fine. And so that's important. So you need to factor that into your costs. And you also need to protect deposits. Now, there's plenty of schemes in the UK that will protect deposits for free. So this isn't necessarily a cost, But if you don't protect a deposit, that can be a cost, because in Scotland, especially where we operate, if it's not protected within 28 working days, the tenant can actually claim some money back from you. So it's important that you do that straight away. So just to be safe, we always just do it as soon as we receive it. So there's no risk of that happening. Now, an EPC is important in terms of costs and management, because a lot of tenants won't want to move into a property if the EPC is low, because it means their bills are going to be high. Obviously, if you've got a really inefficient heating system, really inefficient lighting system, the boiler, etc., then they're going to have to pay a lot of money on their bills, especially if you're not paying for the bills. So yeah, it's really important that we get that EPC to a good standard, even though there's going to be some costs. But it's rather that than, have a property empty, or not having a very good tenant, or having a tenant move out halfway through, the university year because their bills are just too high. So we want to avoid that for sure. You want to build a good team. This is important for management, because you want to know that you have good people that you're working with. So in terms of letting agents, if you're not managing the property yourself, at Pacesetter, I manage the property, so I am the letting agent. But if you are using an agent to manage things, make sure they're good, make sure they're not obviously charging too much. A good rate would be probably, I'd say, 8%. There will be some companies that will do it for 5%, but they might not be the best standard. And there'll be some companies that will do it for 10+%. But that might be too high. Might be a very good standard, but I think 8%, and that's 8% of the monthly rent. Mortgage broker, so you need to deal with someone that knows what they're doing when you're getting financing. There are brokers that will do it for free. However, they might not be the best quality. There will be brokers that will charge you £2,000, but that's too much. We at Pacesetter, we deal directly with the lender, so there's no broking costs. However, in the future, we might look to use a broker, because the lender that we use gives special rates for certain brokers, so they do a lower interest rate. So we'll look at that in the future. Tradespeople, if you're getting people in, you want to know that they're doing a good job and that they're charging the right amounts. And then finally, accountants, you want to make sure that they're doing well as well. So I've got a case study here. This is a real live kind of a deal that we have going through. It's copied and pasted from another slide, so that's why the quality is not so good. So this is just to show you kind of our budget. So we will be paying about 1,800 for solicitors. Taxes are about 2,750. Deposit is 11,500. This because this property is particularly cheap. Usually the properties that we buy are anywhere from 70, 80 to 100. And then we look at the different rooms that we can charge for, and then what's our mortgage payment, and then I calculate the building fees and the insurance and the Wi-Fi, and then I minus that from the profit, from the rent. That gives us our profit, and then we have our after-tax percentage. We do usually aim for 23%. However, this one is a capital and repayment mortgage, so because we're taking a little bit less risk, we're okay with it being a little bit below 23%. So just to finish off, just some common pitfalls to avoid. An important one is to not to over or under price your rent. If you charge too much, you might find it difficult to find good tenants, and the demand might be lower. And obviously you don't want to underprice, because that's going to affect your cash flow. A big one is your tenant screening. You don't really want to let anyone in. You want to be really, really precise about who you let in, really careful, because as I said, and if you only remember one thing from this webinar, it's better to avoid a bad person going in than to get a bad person out. So feel free to say no at the slightest kind of, red flag. And deferred maintenance as well. Don't feel like, oh, I've got a really old boiler and it's going to be fine. It's still got a few years left, even though it's 30 years old. Because if that breaks, tenants are going to have no hot water for the period of time until you get it fixed. So it's just a really, really big hassle. So if you should upgrade something, just upgrade it, and don't take the risk with paying out for your regular monthly costs. All right, that's brought us to everything today. Hope that you guys enjoyed the webinar. We're going to take a little holiday for a couple of months, and then we might be back in September with some more information. But I hope you enjoyed today, and if you have any questions about Pacesetter, please feel free to reach out. Thank you guys, and speak to you soon.